afternoon, ladies and gentlemen. Today is the 17th of March. It is the weekly expiry. The time is 3:50. First of all, what a clean expiry this was. After a long time, it was a very clean and almost no headache kind of expiry. You would have had, if you were shorting calls for whatever reason, maybe a couple of stop losses. But as long as they were a little far away, also it should have been more or less manageable. It was a very one of the easier expiries. I think a little bit of PTSD from me from previous expiries. What's recently been the standard where every 10 rupee option will go to 50 rupees before then going back to 10 and then 50 again. So after seeing all that, today is really very straightforward. So yesterday only I went over what will be my approach for this expiry is to stay very risk averse, because this week has been Monday I didn't trade, Tuesday I didn't trade, Wednesday I didn't trade. So it was all like blank days. And today also not to take much risk. But market just made it relatively easier, even if you weren't taking much risk, to come out in the green as long as you were selling options. Now, first of all, where did we open? What happened? We had this massive gap up. So we had this huge gap up of 300 points. Look, people say, okay, they shorted 17,000 call, they got stuck in it. There's an event. When you take event risk, this happens. So you can't complain. And like people who had short positions in the market from this entire Russia-Ukraine saga, see, there were multiple opportunities to exit if you were holding shorts. No one can deny that. 16,800 has been a support for a huge amount of time. Going back above it, this is a very pivotal level. This gap down below 16,800 only happened when global uncertainty was there. And now as that global uncertainty come back down and we've come back over 16,800, even if you didn't go long here, it was you had to cut shorts here. The 200 DMA also was roughly in the same spot, a little bit higher. There were two entire days of opportunity to cover those shorts. And in those days, so some of the, if there were this week's call options, at least you would have booked a profit on it, more or less. Anyway, so yesterday we had a tremendous gap up, and then again today we had a tremendous gap up combined with a massive crush in India VIX and implied volatility. My idea was, okay, take a wide range and short the 17,000, because 17,000 is where we closed yesterday. So if you look at why 17,000 is where we, it's completely off the chart. So 17,000 is where we closed yesterday. So at the onset, short 17,000 call, and 17,000 put, and 17,400 call, with the put having 50% more premium in it than the call. Because now basically there's going to be a huge support and very unlikely I get pushed out of this position. For a little more credit, right in the beginning, I rolled down my call to 17,350. And one thing became very apparent by 9:30, 10 o'clock, mainly at 10 o'clock. So at 10 o'clock, I tweeted about this also. 17,200 was seeing huge writing. Like even when we went below 17,200 for a little bit, it was seeing huge amount of build up. It became the maximum open interest on any single strike that matters for this expiry. And from that, you could gauge that, see, one of two things will happen. Either like the strike holds, which is very high probability, because that's the amount of writing that was there at that point of time, or there will be a swing down that will push people out of their position. That didn't happen. We made an up move. So I moved my put shorts straight from 17,000 to 17,100. Now I'm on the 17,100 and 17,350 strangle position. That is my position over here. The calls started to expand. I had a stop loss on these calls, which was at 24. So that hit around 11:45. And this is why, so people say, where do you base your stop loss? It's either on the numeric value of how much of a market loss it'll cause me beyond that, or it is on a swing. So I'll tell you where my stop loss was placed. This was the high that it made. Okay, I'm looking at the wrong one. 17,354. This was the high that it made, 22, 20, 23, you can say, over here at 10 o'clock. So my stop loss is just above that at 24. So as we went here, it just missed hitting 24, came back down, and then hit 24. That's where I exited. Now, after I exited, it shot up a lot. It would have been annoying to deal with all this. I exited this, rolled my call higher. From there, the position more or less was fine. Everything, it just played out in range. I think there was just one point where I had to take an SL on a put option. So I had shorted because of how aggressive the up move was. I had shorted 17,250 puts, and I shorted them for a very bad price of like 8.6. I was trying to short at 10. I got a price of 8.7 as an average. Into the down move, that stop hit at around 16, which was the stop. And then I moved my puts back down to 17,200. After that, just trailed till the end. Really, there's not much to go because there's not much that was done in the expiry. So just trailed this position 17,200 and 17,400 all the way from when it had around 12 points all the way to zero. I didn't take any additional risk. I mean, see, even towards the end, there was some amount of opportunity available in shorting the 16,350 and 17,250 again. I just wasn't in the mood to do that because too many recent expiries we've seen 1 rupee options go all the way to 30 rupees. So I guess all of that kind of factors in, because even when my position had just 3 points remaining, and if I moved in one strike closer, I could have gotten an additional 10 points there. Just chose not to do it because just not in the mood to take much risk. Anyway, now I would think this will basically confirm the fact that the so-called uncertainty that's been going on for a while has now been put to rest. And if you see, we've actually moved up from, we were at that 15,500 levels, right? We've moved up from there to 17,300. People ask me, okay, why have I not sold calls against my options? I think Reliance is a prime example of that. Why I have not done a covered call this month. Whenever the market is oversold, if you want to standardize it, if it's trading below like 50 DMA or 200 DMA, selling calls will be pointless, because even if you were doing covered calls, just for example, this 17,000 call, which when we made that bottom, was trading in the 50 rupees range. It went all the way till 50 rupees or so. Now it's trading at 500 rupees. It's gone up 10 times. So I don't look at covered calls as a way to protect the downside on my investment. It's not. It's just a little bit of additional income that you're generating against your shares. So it's not good to do it when the market is tremendously oversold. Anyway, I hope you had a great expiry. This, I don't know, maybe, who knows, maybe this is a sign of things to come, and that we're going to see a relatively less volatile period. It's too early to jump to conclusions on that also. So yeah, let's see. It'll all depend on how markets behave over the next week or two. Thank you so much for watching. There's really not much to cover today because really not much happened. We traded in a very, very clean range. Yes, there were some spikes here as well. This particular spike made me lose about 8 points. I'll go over what happened. So this was the high that we made earlier, and now that was the day's high. That's fine, but we broke. In order to manage this, I moved up my puts aggressively and immediately had to cover at twice the price. So I sold the 17,250 put and had to cover right here at I sold for 8.7, had to cover here for 16 to 17. After that, fully risked off. So just one of those days. Anyway, one other thing is that portfolios will be looking amazing. People who actually had cash available to buy at lower levels, especially at a point where everyone was fear mongering and saying stop your SIPs and all that. All of that will be looking really good. And yeah, thank you so much for watching. I will catch you at the next one. Take care. Bye-bye.